Now, Ibrahim Traoré has led Burkina Faso to its biggest gold year on record.
At first glance, it looks like another IMF headline. $33.2 million approved, program review completed, cautious optimism expressed, routine, technical, easy to scroll past. But pause for a second. Why would a country battling insecurity in the Sahel suddenly post record gold output? Why would its current account flip from deficit to surplus at this exact moment? Why would climate financing be approved not as emergency relief, but as a long-term strategy? And why does 94 tons of gold feel heavier than it sounds? Burkina Faso is not supposed to be the story of economic momentum. It is usually framed through fragility, not surplus. Yet something has shifted beneath the surface, in policy, in posture, in perception. This is not just about gold prices or IMF reviews. It is about control, leverage, and direction. The question is no longer whether Burkina Faso can survive pressure. It is whether it has begun converting pressure into power. Let's find out. "94 tons does not trend on social media. It does not shout. It does not chant. It does not carry flags. But in 2025, Burkina Faso pulled 94 metric tons of gold from its soil, the highest output in its history. And that number did something unusual. It changed the tone of the room. Gold has always been there. Burkina Faso has been a major producer for years. So the question is not what was extracted. The question is who controlled the meaning of it. For decades, Africa's mining story followed a predictable rhythm. International companies extracted, exports surged, GDP ticked upward, but deficits persisted. Public finances remained tight. Revenue leakages quietly diluted the impact. The resource existed, yet the leverage did not. That pattern created a paradox. Countries rich in minerals remained structurally fragile. Under the current administration, the focus was not only on producing more gold, but it was also on tightening the system around it. Mining sector reforms were introduced to increase state oversight. Licensing procedures were scrutinized. Governance integrity and the awarding of concessions became a measurable benchmark rather than a political slogan. This is where things get interesting, because increasing production without improving oversight simply magnifies leakage. But improving oversight while production expands alters fiscal gravity. Gold prices globally have been elevated. That external factor helped. But price spikes alone do not generate macro transformation. What matters is capture. How much of that price movement translates into domestic revenue and fiscal flexibility? When oversight improves, royalties and taxes become more predictable. When licensing processes gain integrity, investor risk perception stabilizes. When the state signals seriousness in managing extractive sectors, revenue volatility reduces. That is not ideology. That is mechanics, and mechanics are what turn commodities into policy tools. 94 tons in isolation is impressive. 94 tons combined with stronger governance is transformative. It begins to explain why external observers started recalculating expectations. It begins to explain why macroeconomic indicators moved in tandem rather than in contradiction. There is also a psychological dimension here. In countries accustomed to external narratives of fragility, resource announcements often feel hollow. Citizens have heard record output before, only to see little change in everyday life. But when record output aligns with fiscal improvement and structured reform, perception shifts. Gold stops feeling like extraction and starts feeling like leverage. And leverage changes how a country stands, diplomatically, financially, and internally. But here is the crucial point. Gold alone does not change destiny. History is full of resource-rich nations that remained economically constrained because extraction was not paired with macro discipline. So the deeper question is this: how did increased production translate into something far more unexpected, a shift in Burkina Faso's external balance itself? How did metal in the ground become surplus on the ledger? The answer to that question is not dramatic. It is arithmetic. When exports rise and imports stabilize, something quiet but powerful happens. The current account shifts. For years, Burkina Faso operated within the familiar pressure zone of many developing economies, import dependence outpacing export revenue, forcing external financing, tightening foreign exchange reserves, and creating vulnerability. Gold would leave the country, but the macro picture would still strain under structural imbalances. In 2025, that equation tilted. With gold exports surging and revenue capture improving, Burkina Faso's current account moved into projected surplus, 1.1% of GDP in 2025 and 0.8% in 2026. That is not a cosmetic improvement. It is a reversal of direction. A surplus means the country earns more from the outside world than it spends. It reduces the need for emergency borrowing. It strengthens external buffers. It improves negotiating posture with lenders and investors. It changes the internal narrative from shortage management to balance management. Think about the strategic shift embedded in that. A country running persistent deficits is constantly reactive. It must secure financing, manage pressure, and absorb shocks. A country running a surplus has breathing space. Breathing space allows planning. Planning allows strategy. This shift did not happen in isolation. It aligned with improved domestic revenue mobilization and fiscal discipline. The government targeted a deficit ceiling of 3.5% of GDP, while protecting key social and health expenditures. That balancing act matters because surplus alone is not enough. Fiscal credibility sustains it. Inflation remained contained. Debt was described as sustainable. Those phrases may sound technical, but they are signals. They tell markets and institutions that macro management is not spiraling. There is a broader African context here. For decades, current account deficits were treated as almost inevitable across commodity-dependent economies. External shocks would widen gaps. Currency pressures would follow. Structural adjustment cycles would begin again. When a country in the Sahel under security strain posts a projected surplus, it disrupts that assumption. It suggests that commodity advantage, when combined with governance reform and fiscal targeting, can break familiar loops. But surplus also raises new questions. Will it hold if gold prices fluctuate? Can fiscal discipline remain consistent if security expenditures rise? Will revenue gains be reinvested productively or absorbed into consumption? Surplus is not a trophy. It is a test. And that is precisely why international institutions began responding differently. Because once the numbers move sustainably in the right direction, external engagement changes tone, which leads to the next critical moment in this unfolding story. If Burkina Faso was still navigating insecurity, why did the IMF not hesitate, but instead deepen its commitment? If the surplus signaled internal stabilization, the next development signaled external recognition. The International Monetary Fund completed the fourth review of Burkina Faso's 48-month extended credit facility program and disbursed approximately $33.2 million. That alone is procedural, a confirmation that performance benchmarks were met. But the deeper signal was strategic. The fund did not pause, suspend, or retreat, despite ongoing security challenges. Instead, it reinforced engagement. Even more revealing was the approval of a $124.3 million resilience and sustainability facility running through September 2027. This was not emergency liquidity. It was structured, forward-looking financing. Institutions like the IMF assess countries through layered metrics: inflation trends, debt sustainability, revenue mobilization, governance reforms, and fiscal discipline. Burkina Faso met enough of those thresholds to sustain program momentum. That changes the geopolitical tone, because when the IMF continues a program in a fragile environment, it is effectively saying, macro management is credible. Risk is being managed. Reform direction is coherent. 6 of 11 priority recommendations under the Governance Diagnostic Assessment were completed, including strengthening the integrity of mining license procedures. That detail matters. Resource governance is often where credibility collapses in commodity-driven economies. Tightening those mechanisms strengthens investor confidence and protects state revenue simultaneously. There is an important distinction here. This was not a bailout to prevent collapse. It was a reinforcement of a reform trajectory. That difference reshapes perception, both internationally and domestically. For decades, IMF involvement in African economies was often interpreted as supervision during a crisis. Structural adjustment in the 1980s left deep scars across the continent. Public sectors shrank. Social spending contracted. Sovereignty debates intensified. In Burkina Faso's current case, the narrative is more complex. Fiscal consolidation is being pursued, but with explicit protection for health and social programs. Inflation remains contained. Debt sustainability is emphasized. This does not mean challenges have disappeared. It means the macro framework is not spiraling. And that matters because credibility compounds. When international institutions publicly describe an economy as resilient amid strain, it influences capital flows, development partner engagement, and diplomatic positioning. It also shifts internal psychology. A country accustomed to external caution now sees continuity. Instead of being labeled too unstable for structured financing, it is receiving medium-term resilience funding. But here is the deeper layer. Why does climate financing sit at the center of this IMF engagement? Why is adaptation, agriculture, and disaster risk now treated as a macroeconomic strategy rather than a humanitarian afterthought? Let's pause for a second to say, big thank you to the Black Culture Diary community, where Black voices, stories, and legacies are preserved and amplified. By becoming a member, you're not just supporting the channel, you're becoming part of a powerful cultural movement. Let's continue. The answer begins far from gold mines and IMF boardrooms. It begins in fields. Nearly 80% of Burkina Faso's population depends on subsistence agriculture. That statistic is not a footnote. It is the foundation of the entire economy. When rain patterns shift, when drought cycles intensify, when desertification creeps forward, it is not just crops that suffer. Currency stability, food prices, rural migration, and even national security shift with them. For years, climate vulnerability in the Sahel was treated as a humanitarian storyline. Drought meant aid appeals. Poor harvests meant emergency imports. International support arrived reactively. The newly approved $124.3 million Resilience and Sustainability Facility reframes that narrative. This is not emergency relief. It is a structural adaptation. The funding is designed to strengthen agricultural resilience, improve irrigation systems, enhance disaster risk financing, and stabilize food production over the long term. That distinction matters because it changes how vulnerability is managed, from crisis response to risk anticipation. When a country reduces its dependence on emergency food imports, it reduces pressure on foreign exchange reserves. When agricultural output becomes more predictable, inflation stabilizes. When disaster shocks are financially buffered, fiscal deficits do not widen suddenly. Climate policy becomes macroeconomic policy. In a landlocked country, food security is inseparable from sovereignty. If staple supplies must be imported during every drought cycle, external leverage remains constant. But if domestic production is stabilized through irrigation, seed resilience, and risk financing mechanisms, dependency ratios shrink. This is not environmental romanticism, it is economic insulation. There is also a social dimension. Rural instability often feeds urban pressure. Urban pressure feeds political tension. Political tension feeds broader instability. When agricultural resilience improves, the migration cycle slows. When livelihoods stabilize, recruitment into destabilizing networks declines. Climate resilience becomes a quiet security reform, and this is where the IMF's engagement becomes strategic rather than symbolic. By approving resilience financing through 2027, the institution signals that adaptation is not peripheral. It is central to economic sustainability. This matters deeply in a region often reduced to headlines about conflict. Burkina Faso's trajectory suggests something different. That long-term stability may emerge not only from military responses, but from irrigation systems and agricultural buffers. But resilience alone does not transform national posture. It reduces vulnerability. So what happens psychologically and geopolitically when a country begins reducing vulnerability at multiple levels simultaneously? When gold production strengthens fiscal space, when the current account shifts into surplus, when climate adaptation reduces structural shocks, How does that reshape how a nation sees itself and how others see it? Here's a reminder to please like and share the video and subscribe to our channel to watch more videos on Black culture, history, civilization, and identity. Let's continue now. The shift is not only economic, it is psychological. For decades, countries like Burkina Faso were introduced to the world through vulnerability metrics, poverty rates, conflict zones, aid dependency charts. Even when resources were abundant, the framing rarely changed. Gold existed, but deficits dominated the narrative. Agriculture sustained millions, but drought cycles defined perception. External institutions arrived during the crisis, not continuity. Now something unusual is happening. A projected current account surplus replaces deficit language. Growth estimates of around 5% in 2026 replace stagnation assumptions. Governance reforms are acknowledged in formal assessments. Climate adaptation is funded before collapse, not after. These are technical changes. But technical changes alter national identity. When a country repeatedly hears that it is fragile, it begins to internalize caution. Investors behave cautiously. Citizens temper expectation. Policymakers operate defensively. But when the macro indicators shift, posture changes. A surplus is not just a balance sheet event. It is breathing space. Breathing space allows planning beyond immediate survival. Planning fosters confidence. Confidence influences negotiation. Negotiation defines geopolitics. Burkina Faso is still navigating serious security challenges. No serious analysis ignores that reality. But when fiscal discipline, revenue mobilization, and structured reform align simultaneously, the national conversation moves from "can we stabilize" to "how far can we go?" That shift matters particularly for younger generations watching closely. For many African youth, the old system feels cyclical. Resource extraction followed by external borrowing, followed by austerity, followed by frustration. The cycle feels inherited. When charts begin moving differently, even slightly, imagination expands. And imagination in economics is not fantasy. It shapes entrepreneurship, investment, and political expectation. There is also an external recalibration. Investors do not ignore security risks, but they also track consistency. When a country maintains inflation control, targets fiscal consolidation responsibly, and strengthens governance integrity, risk models adjust. When international institutions describe an economy as resilient rather than collapsing, diplomatic tone shifts, perception compounds. But perception can be fragile if momentum is not sustained. The challenge now is not to celebrate a moment, but to institutionalize it. Surplus must not become complacency. Growth must translate into diversification. Gold revenue must fund long-term capacity, not short-term consumption. Because resource history across the globe offers a warning. Extraction without reinvestment traps nations in cycles. So the defining question emerges. Can Burkina Faso convert this psychological and fiscal momentum into durable transformation? Can this moment of recalibration solidify into a long-term trajectory rather than a temporary upswing? That is where the story moves next. So we arrive at the edge of the real question. Is this a moment or is it a direction? Because history is full of moments. Commodity booms, temporary surpluses, growth spikes that fade when prices fall or pressure rises. Africa has seen those cycles before. Gold climbs, revenues swell, optimism rises. Then global markets shift, governance weakens, discipline loosens, and the cycle resets. Burkina Faso stands precisely at that fork. The difference between a moment and a trajectory is institutional depth. 94 tons of gold is impressive. A projected current account surplus is strategic. IMF program continuity signals credibility. Climate resilience financing demonstrates foresight. But the trajectory depends on repetition. Will mining oversight remain strict when pressure builds? Will revenue mobilization continue improving beyond extractives? Will fiscal consolidation remain disciplined if political demands intensify? Will climate adaptation funding translate into measurable agricultural stability? These are not rhetorical questions. They are structural tests. Because the real transformation is not gold itself. It is the shift from reactive governance to anticipatory governance. Reactive governance waits for a crisis and then responds. Anticipatory governance builds buffers before shock arrives. If Burkina Faso sustains its reform momentum, if governance diagnostic recommendations continue to be implemented, if revenue capture remains transparent, and if fiscal space is reinvested into productive capacity, then something rare will have happened in the Sahel. A resource-driven economy would have strengthened without collapsing into volatility. That outcome would matter far beyond Ouagadougou. It would challenge the long-standing assumption that security strain automatically blocks macroeconomic discipline. It would demonstrate that sovereignty and solvency can coexist. It would show that reform under pressure is possible. But sustaining a trajectory also requires diversification. Gold cannot remain the single engine. Agricultural resilience must increase output stability. Infrastructure investment must deepen domestic productivity. Institutional modernization must outlast personalities. Because true sovereignty is not tied to one leader or one boom. It is tied to systems. And systems are built slowly. This is where Ibrahim Traoré's administration faces its defining chapter, not in rhetoric, but in institutional permanence. If reforms are embedded into bureaucratic culture rather than political cycles, then this period will be remembered as structural. If not, it will be remembered as temporary. The trucks will continue to move, the fields will continue to depend on rain, and increasingly, on irrigation. IMF analysts will continue reviewing benchmarks. Investors will continue recalculating risk. But the trajectory is not decided by headlines. It is decided by consistency. Burkina Faso has shifted posture. It has demonstrated that pressure does not automatically equal paralysis. It has shown that numbers can move even in difficult terrain. Now comes the harder part, making movement habitual. Because in geopolitics, power is not loud, it is steady. And steady is what turns a hotspot into a foundation. Let us know in the comments section, will Burkina Faso change permanently? Do you want to watch more videos like this one? If so, subscribe to our channel and press the bell icon next to it. We have decided to bring videos on something nobody talks about: the Black culture, civilization, history, and evidence about how glorious Blacks have been. Thanks for watching, and until the next video, stay tuned.